So you've got some money sitting in the bank and you would like to start investing, but then you open the news and you see Trump attacking Iran, oil prices exploding, inflation shooting up, and experts warning of an AI bubble. And you think, this feels scary, maybe I should wait. Well, that's an understandable reaction. But based on my 19 years of investing experience, both on Wall Street and as an investment company CEO here in Europe, it's probably a mistake. Instead of fearing a market crash and letting that stop you from investing, you should ask, how do I invest so that I will be fine no matter what happens in the market? Because face it, do you really think the world is about to calm down and get less crazy? If you wait for that, you're going to be waiting for a long, long time. And in the meantime, I can say one thing for sure. The money that you've got sitting in the bank will keep losing value, month after month, year after year. To understand why that is, let's look first at the Iran conflict and then at the AI revolution. For months now, Iran has closed the Strait of Hormuz. That is the narrow stretch of water connecting the Persian Gulf with the Arabian Sea, which normally carries 20% of the world's oil. As a result, oil prices are up 70% this year, and they are likely not coming all the way down even when the war ends, because there is just too much damage in the region from destroyed infrastructure and shut down production, and this can take months or even years to reverse. And the problem is, our world runs on oil. It's not just your car. All the goods at your local store were carried there by trucks burning diesel. Virtually all plastics are made using oil products. A lot of people heat their homes with oil. Plus, oil isn't really the end of the story here. Roughly 1/3 of the world's fertilizer and 1/3 of the world's helium also go through the Strait of Hormuz in normal times. A lack of fertilizer means massive disruptions for global agriculture, and a lack of helium means disruptions for the semiconductor industry. Now, in the global economy, making any kind of reliable predictions is difficult. But what is coming next is really difficult to avoid. It's like this tsunami that we can all see out at sea. Right now, everything is peaceful and calm on the beach, but that big wave, it's coming, and there's no way to stop it. For the global economy, the tsunami is inflation. Everything is about to get more expensive. And if you've got cash sitting in the bank, it is about to lose its value. Now, what is the classic way to guard against your money losing value? Of course, it's investing. Put your cash into a stock fund that invests your money in hundreds of companies around the world. Because historically, the stock market has been great at protecting your savings from inflation over the long term. But you might have a natural objection. Well, yes, the Iran conflict will cause high inflation, but it could also cause a stock crash. So isn't that even worse? Now, sure, a stock crash is entirely possible, and in a minute I will explain how to position your portfolio appropriately for that risk. But first, let's be clear that a major stock crash is not a certainty. When you look at history, inflation shocks can lead to different outcomes in the stock market. The best known example is the 1970s. When the Yom Kippur War broke out between Israel and Arab countries in 1973, the oil price quadrupled, which is a way bigger increase than what we are seeing today. And this caused massive oil shortages around the world. People had to wait in long lines to fill up their cars. As a result, throughout the 70s, the world struggled with rising prices. US inflation hit 14% per year in 1980. Against this backdrop, stocks really didn't do that well. The US stock market crashed by half between 1973 and 1974. Then it rebounded and bounced up and down for years. By the end of the decade, the result didn't look that bad. In nominal terms, the US stock market delivered a positive total return of around 67% between 1972 and 1980. But in real terms, after you take away inflation, you would have lost around 18% of your purchasing power if you held a portfolio of stocks. Now, that is not a great outcome. But when people call the 1970s a lost decade for stock investors, here's what they miss. If you simply held cash instead, you would have done much, much worse. You would actually have lost half your wealth, not just 18%. So even in the 1970s, you were still a lot better off holding stocks than cash. And this was followed by really tremendous results for stock investors in the 1980s. Let's look at another historical oil shock. But first, here's a quick note. The months up ahead are likely to be intense for investors. unless you're a financial expert, when the news headlines get scary, it's hard to know what you need to pay attention to and what is safe to ignore. That is exactly why I write a newsletter for European investors. In it, I cover market news, personal finance tips, and investing insights for people who live in Europe. To join my more than 90,000 newsletter readers, just follow the link in the description. Okay, so let's look at another couple of inflation shocks. First up, we've got 1990. This is when Iraq invaded Kuwait. As a result, oil prices more than doubled. And again, that's a bigger price spike than what we're seeing today. What happened next? Well, the US stock market dipped for a few months, but then it recovered. Stocks went on to produce massive results throughout the 1990s. Holding stocks was a much smarter choice than being in cash. More recently, the world saw tremendous levels of inflation during COVID in 2022. In my country, Latvia, inflation reached over 20% per year. In the US, inflation peaked at 9% per year. And as a result, US stocks dropped as much as 25%. But within a year or so, the market recovered, and it went on to post one tremendous year after another until today. Looking back, people who held cash since the start of COVID got really punished, while people who were invested in stocks grew their wealth significantly. Now, there are no guarantees that this time will be the same. That said, there are some reasons to be more optimistic about the long-term results of today's oil shock than in the 1970s. Global GDP has grown strongly since the 1970s, but global oil output has not grown nearly as much. That means today the economy is much less dependent on oil. And in recent years, there's been a very fast rise in the world's use of renewable energy like solar and wind. Plus, the last few years have shown us that companies and governments are quite flexible when it comes to switching energy sources. When Russia invaded Ukraine, Europe was heavily dependent on Russian natural gas for running its factories and heating its homes. But for political and military reasons, this supply collapsed. Russia's share of EU gas imports dropped from around 40% in 2021 to just 6% in 2025. Now, as Russian gas became unavailable, many experts thought Europe would face heavy shortages and economic collapse. But Europe adapted much faster than analysts expected. First, the EU switched to other energy sources. Demand for natural gas declined by over 19% between 2021 and 2024. And second, a lot of the remaining shortfall was made up by liquid natural gas imports from other regions. This is just one example of a general principle. When supply shocks happen, the world adapts. What seems like an inevitable disaster at first often becomes a manageable disruption within a few years. So, looking at this whole picture, what can you say about the Iran crisis and investing? Well, no one can tell you for sure what will happen with stocks over the next few years, but here's how I look at it. If you don't invest, you are pretty much guaranteed to be hurt by high inflation. If you do invest, it is still very possible your portfolio will go down in the short to intermediate term. I mean, if you're expecting the market to definitely go up over the next few years, you could be in for a disappointment. But I don't expect this crisis to be an issue for the global economy in a time frame of 5 to 10 years. As a longer-term stock investor, especially if you're just starting out with investing, I would not be that concerned. Alright, so that's the Iran crisis. Now let's look at another concern that many beginning investors have, which is a potential AI bubble. In recent years, big American tech stocks like Nvidia, AMD, Micron Technology, Google, Meta, and Microsoft have shot to the sky. These huge price increases have been driven by fast-growing AI revenues and optimism that this new technology is about to change the world. But what if AI is an overhyped bubble and these stock prices collapse? Today, just 10 big tech stocks make up around 39% of the S&P 500 stock index. If their prices fall, the whole market could crash. Now, to be clear, this is entirely possible, and in a minute, we'll talk about how you position your portfolio in case that happens. But before we get to that, let me ask you a simple question. How often do you use AI tools like ChatGPT or Claude in your work? When I ask this question in my investment webinars these days, usually half the audience says they use these tools every single day, and around 30% say they use them several times a week. When I ask people, has AI helped your productivity, around half say yes by a lot, another 20% say yes, at least a little. So that's 70% of people today seeing productivity gains in their daily work. When AI models like ChatGPT came out a few years ago, I got super hyped. And then, like many people, I became a bit jaded, a bit disappointed, because we all saw that AI hallucinates a lot, which is still true today, and it makes a lot of mistakes. But over the past year or so, talking to a lot of people in many different businesses, pretty much everybody I meet is using these tools to work faster and more efficiently. And then you have the news headlines. Recently, Anthropic released its Claude Mythos AI, which is a cybersecurity tool so powerful that it's discovering hundreds of software vulnerabilities that people have missed for years. Or you'll read headlines about ChatGPT helping solve difficult theoretical math problems that have puzzled professional mathematicians for decades. Here's the point I'm making. Yes, there is a lot of AI hype out there. And no, you can't just blindly go to an AI and ask it to fix your business problems or to tell you which stocks or ETFs to buy or how to handle your taxes. But at the same time, if you know how to use AI correctly, if you understand the limitations, it's an extremely powerful tool, which is making a big impact on businesses right now. It is not all just hype. There is a there. So does that mean that you should rush and buy tech stocks today? Well, not so fast. Stocks like Nvidia have returned tremendous results over the past 5 years, but their current stock prices are quite high. They already reflect a lot of optimism about the future. And you've got to remember the years 1999 and 2000, when many internet stocks like Yahoo.com, AOL, and Cisco shot to the sky. This was followed by the dot-com crash, when the tech-heavy NASDAQ 100 index lost 80% of its value. Many of the biggest stocks from those early days went on to perform poorly or even disappeared entirely. Two things can be true at the same time. The AI revolution can be massive, powerful, and world-changing, and there can still be a big risk of an AI bubble and a stock crash along the way. The way I see it, eventually AI productivity gains are going to show up in economic output. They're going to show up in corporate profits for companies all around the world. But the timing is uncertain, because transitioning to any new technology means a lot of disruption as old processes get replaced and new skills need to be learned. In the short to intermediate term, don't count on the market to go up. Maybe it will, maybe not. But if we're looking at a long-term picture, 5 to 10 years or more, well, just think about it. There are millions of people going to work at thousands of publicly traded companies around the world. And today, half of them are using AI tools to be more productive. Soon, that's going to be 70 to 80%. So if this is true, and if we accept that AI is not just hype, that there is actually a game-changing technology there, then this kind of impact should really add up over the years. Yes, starting to invest today carries significant risks, but in my view, not investing today is a bigger risk, not just because of inflation, but because you risk missing the boat. You risk missing owning a part of the global economy as AI transforms productivity over the next years and decades. Okay, but what is the smartest way to start investing today, especially given the short-term risks that we are seeing with both the Iran crisis and the AI revolution? Well, in my view, the answer is the same as it has always been. Stick to the basics. Step 1, make sure you've got a good safety cushion sitting in a bank. This is money that is not invested, that is available to cover your costs if you lose your job or have an emergency. Step 2, pick an appropriate level of risk for your age and your time horizon. If you're in your 30s or 40s, you can afford to take a lot of risk and be mostly in stocks. If you're closer to retirement, you need to be more cautious. And then there's step number 3, diversify, diversify, diversify. Don't bet everything on a few big tech stocks. That could pay off big time, but it's also very, very risky. Put your investments into hundreds of different stocks in different regions and different industries around the world. The way I look at it, the real benefit of the AI revolution will not be limited to tech companies. It will be spread throughout the economy as all companies become more productive. Now, what is the easiest way to diversify your investments when you're just starting out and you're not a finance expert? Well, of course, it's to buy an ETF or index fund. Historically, ETFs and index funds have outperformed the vast majority of competitors. That's how I invest my family's money. That's also what Warren Buffett recommends for most investors. To me, unless you want to be a professional investor, putting your money into an ETF or index fund is the no-brainer choice. That said, here in Europe, starting to invest in ETFs can be a little bit tricky because there are over 4,000 different ETFs to choose from. To find out how to make that choice, watch this video next, where I explain the best approach to ETF investing that I know.